Okay, well, thank you all for being here today. My name is Ilana Tell-Oren. I'm the Alumni Engagement Associate here at Cal State Long Beach, and it is my pleasure to introduce Oscar Velasco, who is with us from Long Beach Financial Credit Union, and he is the Business Development Special at LBS Financial Credit Union, and he'll be the one leading us through the presentation today. So if you do have any questions, please feel free to use the Q&A or the chat, and I will do my best to relay any of the questions to Oscar as well. And Oscar, feel free to go ahead and take it away.
All right, so thank you so much for having me today. My name is Oscar Velasco. As Ilana mentioned, I am with LBS Financial Credit Union. We're a local credit union here based out of Long Beach. We actually have a branch here on campus on the second floor of the bookstore. A little bit more about me before we get started. As Ilana mentioned, I do oversee the business development for the credit union. Two main things that I do is I go out and introduce the credit union to a lot of the schools, local businesses in the area. And second, I manage our financial literacy program. A little bit more about the credit union. We were established back in 1935. So we've been in existence for about 91 years now. 250 employees. We serve over 140,000 members. And we do control $2 billion in assets. I get this question a lot, and I always kind of forget to answer it. What is the difference between a credit union and a bank? Couple reasons, couple differences. Main thing is we are not for profit. So our profit, yes, we're in it to make money, of course, but our profit is meant to go back to our members in the form of lower bank fees, for instance, lower interest rates on your car loans, things of that nature. That's why when you hear a lot of people, if you're in the, for instance, trying to get a car loan or a home loan, they always recommend that you go to a credit union because we typically give lower interest rates than most, the bigger banks, things of that nature. So the big difference is, of course, we're not for profit. So today we're going to talk about credit. We're going to talk about how, credit confidence work, how to build it, use it, and protect it. Very important seminar. I actually think out of all the seminars I do, I love talking credit just because it is going to affect you in every way possible these days. Why is credit important? Well, it can affect you in so many ways. Applying for a job, renting, buying a home, qualifying for a car loan, insurance premium. Believe it or not, your insurance premiums can go up if you have poor credit. And of course, it could even affect you getting a cell phone. So these are the things we're talking about today. Again, building it, using it, how to protect it. As we go through the presentation, if you do have questions, feel free to put them in the chat, or if you want to wait for to the end. But if you have a question that you just like, I have to ask this question, put it in the chat, and then I'll get to it as soon as I can. So, of course, we're talking about credit. One of the most important aspects of our credit is your credit score. Everyone here probably is going to be 18 and over. So if you are 18 and over, most likely you have a credit score, right? Most likely you hopefully know your credit score. If you don't, I always tell people, don't run away from your credit. Know your credit score. If it's not where you want it to be, try to improve it. Today you'll learn, you'll learn how to improve it. You'll learn what's the impact of it, and you'll learn how to benefit from it. So FICO score, most commonly used by lenders, 300, 400, 500 is poor credit. 600, it's okay. Tends to be fair, average credit. Once you get to about 650, that's pretty much the average in the industry. 750 is good to excellent credit. Where do you want to be? What should your goal be when it comes to a credit score? Should your goal be to have a perfect credit score? No. Your goal should be to be over 750. That's what the industry likes. That's going to give you the opportunity to get what we call in the industry A+ credit, 750 and above. So just keep that in mind. That's where you should be. So how do you get there? How do you get to a good credit score? Well, this is how you get here. Keep in mind, a credit score can move around. It does adjust depending on how you use it, right? Of course, it's going to go down if you miss a payment, things of that nature. But this is how we base it on. This is, of course, a pie, right? We're going to break it down. 35% of your credit score is going to be payment history. Do you make your payments on time every single time? It's very important that you make your payments on time, right? So, do you make your payments? I've been in the banking industry for over 25 years. I always get quite a bit of people coming in, making trying to get a car loan or a home loan, whatever type of loan there is. And I would ask them, do you have good credit? Have you made your payments on time all the time? Yes, right? If they tell me yes, are we going to believe someone? Fortunately not. We're going to run your credit report. And if it shows up that you missed a payment, maybe 2 years ago, maybe 3 years ago, maybe 4 years ago, guess what? We could potentially dock you. And when we say dock you, we could, typically that means increase your interest rate we're providing to you because you missed one payment 3, 4, 5 years ago. It still counts against you. So just keep that in mind. 30%. This is what I call the 30% rule. What is the 30% rule? Specifically pertains to credit cards. If you have one credit card, financial institutions do not like you to owe more than 30% of your credit card max. What does that mean? If your max is $1,000, you should not owe more than 30% or $300 on that credit card. Let's say, for instance, you have $300. You have 3 credit cards, and each one of them is a max of 1,000. You should not owe more than $300 on those credit cards. So just keep that in mind. Limit of credit history is 15%. I highly encourage everyone here who doesn't have a credit card to go out and get a credit card as soon as you can. Why? Because you want to start building your credit when you don't need it. Let me repeat that. You should build your credit when you don't need it, because when you do need it in the future, let's say, for instance, you want to graduate, you want to start your own business, you need a business loan, you want to buy a home, you want to buy a car, things of that nature, you're going to need credit. It's good to have some established credit, and most of the time that's going to be using a credit card, things of that nature. So you want to start using it for you could first of all learn how to use it, right? Learn how to manage it. And secondly, you want to give the opportunity for financial institutions to recognize that you understand how to use it, right? That you know how to manage your credit. New credit 10% of the time. Of course, this is very key because what happens when people get new credit cards, when they go out and get a new credit card, you're 18 and you run out and get a new credit card, 40% of Americans, unfortunately, they max it out, right? And they start taking advantage of their credit. But in reality, you're not taking advantage of your credit. You're burying yourself in debt. So just keep that in mind. You want to make sure 10% of that new credit is, very important that you don't max it out, things of that nature. Also, things to look out for. I always get this question, how do I get a good credit score? If I've never had credit, how do I establish credit? Well, certain things you could do. Of course, go out and get a credit card. Use your credit card, right? Don't max it out 30%, right? Now that you know how credit scores work, use that to your advantage, right? Start using it as soon as possible, right? Keep it under 30% usage. And of course, make sure you pay your payment on time. That will assure you that you have good credit. So I have the scenario here. Love putting up the scenario. Who has the better credit score? Let's assume Jonathan is in the credit union today and Andrew as well. They're both in trying to get a credit card, right? Try to get a car loan. They have only one credit card. So let's assume they only have one credit card. Jonathan's balance is the 900. His limit is $1,000. He plans to pay off his entire balance at the end of the month. Andrew owes 10,000. His limit is 20,000. He plans to, of course, he's only paying the minimum because who could pay $10,000 in a month, right? Who, based on this scenario, in the chat, guys, if you could put in the chat, who do you believe has the better credit score? Is it Jonathan or is it Andrew? In the chat, guys, go ahead and do it at this time. Let's see who it is. Okay, one person says Andrew. Give a couple more seconds for anyone else that wants to join in. Who do you believe has the better credit score? Is it Andrew or is it Jonathan? Jonathan, okay, I got another one for Jonathan. Okay. Who do you think has Jonathan? Okay. Now, the person who answered Andrew, why do you think Andrew has a better credit score? I'm just curious. Not saying you're right or wrong, just curious. Why does Andrew have the better credit score there? He's using less of his max. That is actually correct. In this scenario, Andrew has a better credit score than Jonathan. Because if we look back, one of the key factors of your FICO score is the 30% rule, the 30% usage. Yes, Andrew is at 50%. We wish he was at 30. 30% is a lot less than 90. And keep in mind, guys, a financial institution looks at your financial picture at this current moment. We don't care what Jonathan plans to do at the end of the month. Right now, Jonathan is at 90%. Now, he might say, yeah, I plan to pay it off at the end of the month. Guess what? Everyone says they plan to pay their bills off at the end of the month. Does everyone pay their bills off at the end of the month? No, they don't. That's why every financial institution has a collection agency. So just keep that in mind, right? Who has better credit score right now? Andrew. Now, is that good for Andrew? Probably not, because it's probably going to take him 10 years making the minimum payment to pay that off, and he's going to pay several $1,000s in interest. But keep in mind, guys, a couple pointers that I will give you guys here. A couple bonus points. Oh, did I stop sharing? I'm so sorry. Sorry about that. Let me just couple pointers that I'll mention here. Going back to the FICO score, right? Now, we talked about the 30% rule. Yes, he owes, he's at 50, so that's why he has a better credit score. But let's assume now that Jonathan right here is at 90%. Here's a pointer I want to give you guys, a tip that could help Jonathan right now. So let's say, for instance, Jonathan, yes, his max is $1,000. Let's say, for instance, Jonathan got this credit card 2 years ago, right? And he's been paying it off on time. He's good on payments. He's never late. He's never missed a payment. Well, you know what Jonathan can do to increase his 30% rule? He could call his financial institution and just simply say, hey, financial institution, is there a way I could increase my credit limit because I'm thinking about making a major purchase, or because I want a higher credit limit? It's as simple as that. And the financial institution is going to run his number. And maybe Jonathan 2 years ago was working part-time because he was going to school. Now he's working full-time. And guess what? The financial institution might say, yeah, you know what? based on your new income or based on your credit history that you now have, guess what? Now you have a limit. We could provide you with the limit of $3,000 or $5,000 as your max. Because if Jonathan, guess what, had a max value of 3,000 instead of 9,000, and he owed 900, he would only be at 33% usage, right? So that's a tip you can use, right, in the future, now that you kind of know how the 30% rule is, to help you, right? Keep that in mind. There's different approaches that we could use. That's why it's important you attend these workshops to find out how you can maneuver your credit, because, again, it's only making a quick call and understanding the situation that you're in that maybe you can improve it right then and there. Also, if Jonathan knew how credit worked, maybe when he pays off his credit card, he can go and he instead of going now, he waits a week until he pays off his credit card, and now his balance is at zero, and maybe he has a better credit score, right? Because his credit score adjusts, right? It goes up and down. So keep that in mind. Little different pointers that you could use maybe in the future, because I do run it, sometimes people get credit scores, right? People get their credit cards a few years ago and your situation has changed, right? Maybe you got your first credit card when you were 18. You started off at Cal State Long Beach. Now you're 21. Maybe you're working longer hours, or maybe you already, let's say, for instance, in a year, next year, you graduate already and you're working full time and you got a better paying job. Now you deserve a higher interest rate. Now, I'm not encouraging you to go out and max out your credit card. That's something I wouldn't encourage you to do. But as far as for the amount owed for the 30% rule, keep that in mind. That can help you, right? That can help your credit score. So just keep that in mind. Just knowing little tips like that can help you in the future. So these are the three main reporting agencies we use: Equifax, Experian, TransUnion. Keep this in mind. It's very important that you run your credit. Most experts recommend once a year. It's completely free to do, right? I would suggest you run it. Make sure you run it. Look at the report. See if there's any errors on there, right? If my name is Oscar Velasco. I don't have a middle name. So let's say, for instance, I run my credit score today. And when I run my credit report, I find on my credit report someone named Oscar Michael Velasco did inquire a credit card inquiry on me. Would that raise a red flag to me? Yes, because again, I don't know who Oscar Michael Velasco is. I don't have a middle name, right? I've lived in California all my life. Let's say, for instance, someone tried to run my credit in New York. I've never been to New York. That should raise a red flag to me, right? Little things like that, you should be able to understand your credit, because again, when you turn 18, we all have credit scores. It is your responsibility, right? Because there's a lot of people out there that unfortunately try to take advantage of you. There's a lot of people out there that are going to try to steal your identity, that are going to try to steal your information. And a lot of times it's not your fault, right? There's different companies out there, right? You got gotten the letters, oh, you shopped at Target or you shopped here and there, and they had identity theft. Now your information was potentially stolen, right? So now they have your information. So just keep that in mind. Very important. The record information. So what happens when you don't pay your items? What happens when you say, I just don't want the car anymore? Well, there's consequences. And remember when I talked about the three main reporting agencies? Well, they monitor these consequences. So let's say, for instance, I had a credit card payment and I missed it, right? Or it was late, or I just didn't feel like paying for it. It's going to stay on my report 7 years. Repossessions, car repos, right? 7 years. Student loan default. Hopefully none of you have student loans, but if you do, decide not to pay it when it's due, 7 years. Tax liens, 5 years, paid 7. Judgment, 7 years. And, there's bankruptcy, of course. Chapter 17 year, Chapter 13. Chapter 7, 10 years. Chapter 13, 7 years. Look at these numbers, guys. These stay on your credit report. And keep in mind, when you're out looking for a business loan, when you're out looking potentially for a home loan, a car loan, things of that nature, these records stay on file. A financial institution is going to do their due diligence before we give you a loan. So guess what? We're going to look for these, right? I've done hundreds of loans in my career, and there's been times where I'm doing a car loan, a home loan, and my back office says, hey, you're doing this, you're doing a car loan or a home loan for this person. We just looked at their credit report 5 years ago. They missed their payment, right? Or their payment was late. Guess what? If you're trying to do a home loan, now they're going to require me to give you an increase on your rate. And it could be a quarter percent, right? 0.25 interest rate increase on your rate now, right? So instead of, let's say, for instance, your home loan being 6.75, now it's going to be 7%. Well, guess what? If you're doing a home loan for $1 million, that quarter percent interest rate can be 10, 20, 30, $50,000 more than you're paying now, right? Throughout the life of the loan because you missed a payment 5 years ago. So just keep that in mind. It's very important when it comes to credit that you know what the consequences are, because you want to put yourself in that scenario, right? 7 years is a long time. Think about that, guys. You miss a payment today, April 21st, 2026. That stays on your record till April 21st, 2033. So just keep that in mind. That is a long time from now, but it stays on your record, right? It's not something you can erase, right? You can't change your name and all of a sudden have a new credit score. It doesn't work that way. I like to always bring this up because people do not know the consequences or what is the true meaning of being a co-signer on a loan, right? When you are a co-signer on a loan, who does the loan belong to? It belongs to both of you. Keep in mind, both of you, it is both of your loans. Keep in mind also, if that person you're co-signing for decides to default on the loan, it is going to hurt your credit score. It is going to potentially damage it. Well, not potentially, it will damage your credit report. I get this question a lot. Can I be removed from a loan that I signed on a later day? If I co-sign today, let's say, for instance, I'm co-signing for my brother today. Can I be removed from the loan? Yes, I could. There's two ways to remove you from a loan. You could either get out by refinancing it, right? Refinancing, have your, like for instance, in my case, I co-signed for my brother. My brother would need to will get a loan on his own and remove me from the loan. Now, if he needed me to get that loan, it's going to be hard for him to get another loan on his own, right? So just keep that in mind. It's hard to do. Second way is to remove me from the loan is if I die, right? I die, come in with death, my brother comes in with death certificate, I'm removed from the loan, right? What happens to the loan? It could affect me. Will being a co-signer impact me from getting my own loan? It can. This is my suggestion to you. If you've ever been approached or have been approached or will be approached as a co-signer, because you will be approached to co-sign. And this could be from your mom, your dad, your parents, your grandparents, your boyfriend, girlfriend, partner, cousin, best friend, whatever it is, your teachers, whoever it is. I've seen it all. If somebody would come up to me and say, can you co-sign me? Can you co-sign for me? I would look the other way and run away as quickly as possible. If they stop following you on Instagram, if they break up with you, If they hate you, you know what? Good. Because I have seen it so many times, guys, where someone co-signs for them and it destroys them. Not only their credit, but it destroys their life. Let me tell you guys a real scenario here that happened with someone being a co-signer. So about 10, 15, probably like around 15 years ago, I was working at a bank. Young man came into my branch. He was a customer and he said, "Hey, Oscar, I'm trying to get a car loan." Great. Let's try to do a car loan for you. As we were doing the application, I already kind of knew because of my experience that it was going to be hard for him to get a car loan on his own. And yeah, we ran the numbers, things of that. I submitted the loan, and they came back and denied him. His credit score was bad, and he just didn't have the income, right? So he made the suggestion. Well, what about if I get you could get it? He was like, well, how can I get the loan? I need a car. Well, of course, we're going to suggest a cosigner. Do you have a cosigner? Yeah, you know what? I have my sister. She's willing to be a cosigner. So she came in the next day and she said, "Yeah, you know what? My brother's been a knucklehead all his life, but I see him changing his life around. Um, I'm gonna be a cosigner on his car, because he needs a car. He's trying to fix his life. He's been goofball his life, and he's ready to change his life, right? So let me cosign." Great. So I talked to her about what it means to be a cosigner. She's like, "Oh yeah, my brother's good. I know he'll pay, things of that nature." Great. Cosigns. Of course, she co-signed. She's a little older. She's more established. She has a home, all that good stuff. She has a good job. So we're like, "Hey, yeah, you co-sign. We could do the loan." Great. So they're both on the loan, right? He goes out, buys a car, all that good stuff. Of course, she's on the car loan because she's on the loan, right? About 6 months later, she comes into the office. And she comes into the office and you could tell something's not right. And she said, "Hey, Oscar, you know, what can I do here? Because a few weeks ago, right, my brother was in a car accident. He was in a car accident. He unfortunately injured someone in the car accident. And unfortunately, he had a little bit too much to drink, right? So he was drinking, hit a car, injured a driver, right? He was injured himself. They were both injured. Luckily, both of them survived. But now he was in jail, right? He's in jail because, of course, he hit someone. And so now they're holding him because they can't bail him out. They don't want to bail him out. So now the car is destroyed, right? The car was totaled. And to make things worse, he had established car loan. He had established car insurance, but he had lapsed on his car insurance. So he didn't pay the car insurance. So guess what? The car didn't have car insurance. So what happens, of course, is the driver now wants to sue the owner of the car. So who is the owner of the car in this case? In the chat, who is the owner of the car? Because the brother's the one that caused the accident, right? Who is the owner of the car in the chat? Who do you think is the owner of the car? And who are they going to sue? Is it the brother, the sister, both? Give a few more seconds. Who's the owner of that car? The sister, the brother, or both? It's going to be both, right? Both are the owners of the car. And guess what? And guess who they're going to go after? They're going to go after the sister. Why? Well, because the sister is, of course, well off. She has a house. She has more money, right? So now she is getting sued, right? Because now there's someone that's injured And this person, unfortunately, her brother didn't have, there was a lapse in his car insurance, right? And now they're coming after her. Oh, and by the way, the sister didn't tell her husband that she had co-signed for this car, right? So now the husband is upset because now potentially they are going to get sued and they are going to lose a lot of money. And they're potentially might even lose their home, right? So just keep that in mind. These are things that can happen. Now, this is an extreme case. I realize that, but it happened, and the sisters now is destroyed, right? Financially, potentially, because guess what? Her brother doesn't have any money, right? But she does, and now she's gonna have to pay for it. And guess what? Not only is she's probably gonna get sued, not only is she gonna get sued by the person her brother hit, but guess what happens to the car loan? The financial institution, we still want to get paid, right? So we don't care if the car was total. We still need to get paid. So guess what? If she misses a car payment, which he probably will be, right? Because he's going to do some time in jail, right? So if she doesn't pay, guess what? That loan is going to go to default, and it's going to not only destroy her financially, but also her credit, right? All because she decided to be a co-signer. So just keep that in mind. Not trying to scare anyone away from being a co-signer, but those are the facts, guys. So just keep that in mind. I've seen it happen quite a bit of times. So just keep that in mind. It's hard. It's hard to say no when it comes to a co-signer, but it happens, guys. Credit cards. I talked a lot about why is it important to get a credit card, start your credit card, things of that nature. But I'll be honest with you, having a credit card is very tempting. And there's a lot of people out there that do not know how to use a credit card, that do not know how to manage credit, and then get themselves into a lot of trouble. I ran into students all the time. At Cal State Long Beach, we have a branch there on campus. I do a lot of work there. I do a lot of financial literacy. And the students will come up to me and say, hey, Oscar, what can I do? I'm in debt. I owe $5,000, $10,000, $15,000, $20,000, $25,000, $30,000 in credit card debt. What can I do? I'm like, well, you know what you could do? You could pay that off. Don't run away from it. Get a second job. Do what you got to do to pay that off, because that balance is not going to go away. First thing you need to do is stop using that credit card, right? Create yourself a budget. But look at what happens. $2,500, 18%. If you only make the minimum payment, that payment is going to be 10, it's going to take you 123 payments or over 10 years to pay that off. And you're going to pay $39.15. That's over $1,400 interest you're paying on whatever you purchase for $2,500. And it's going to take you over 10 years making the minimum payment. Now, you might say, well, why don't you just make the minimum payment? Yes. Well, 40% of Americans only make the minimum payment, guys. So credit is bad. Credit card, could be a nightmare for some. Because if you're just making the minimum payment, you're basically throwing away your money. Remember in the case of Andrew, yes, he had a better credit score, but he owed $10,000 and was only making the minimum payment, right? That's a double-edged sword, because he has a good credit score, but right, he had the better credit score, but he's only going to be, he's going to be paying thousands of dollars in interest rate, in interest. So that is bad, guys. So minimum payment, look at the third line, 2,500, 18%. If you make the minimum payment, keep this in mind. In this case, the minimum payment is going to be like $80 a month. Plus $50, you only at least make only 33 payments, right? Or, 3 years, let's say. And you only pay 28, which is about $300. So try to make more than minimum payment, guys. Or even a better suggestion, when you have a credit card, just try to purchase something on a credit card that you can pay off immediately. right? A pet peeve of mine. I'll tell you a pet peeve of mine. So I table at Cal State Long Beach, as I mentioned, quite a bit. And one of my pet peeves is when a student comes up and says, "Hey, Oscar, um, what kind of credit cards do you guys offer?" And I'm like, "Oh, we offer, cash rewards, or we offer, just a basic credit card." And they tell me, "Oh, do you have, the black card? Do you have a platinum card? Do you have like a high rewards card? Do you have a mileage card? Do you have all these different credit cards that you see advertised on TV or online or on different things?" It's my pet peeve. Why? Because the students don't understand the potential problem they're getting themselves into. First of all, 99% of you, let's just be honest, you guys are struggling college students, right? 99% of you are. You should not have a platinum credit card. You should not have a mileage credit card. Why? Because you're never going to reap the benefits of it. For instance, I once had a person tell me, and he was pretty much telling me like, "Hey, I need this credit. I like the features on this credit card. Can you guys match the features?" And I said, "What's the credit card?" So it was something like some American Express airline miles. You get to stay in like free lounges at the airport, and you get triple the gold points when you fly this airline and all this stuff, right? Well, that credit card had an annual fee of $300 if you didn't make certain requirements, right? You had to travel like 3 or 4 times a year on a specific airline, right? You had to use it, right? Your first year, you had to charge, I believe, like $12,000 in charges, right? And it had all these stipulations. And I told the guy, I'm like, "Well, do you plan to travel?" "Well, I'm hoping to travel when I graduate." "Yes." "So you're hoping to travel. You don't really travel." So I guarantee you, I told him, I was like, "I guarantee you, you get this card, you're going to be paying $300 a year for this card, and you're not going to reap any benefits of it." Because why? Because you shouldn't be making that many purchases, right? You shouldn't be charging $8,000 or $12,000, whatever the minimum was on that credit card to reap these benefits. Because most likely, keep in mind, this person was a part-time student working 20 hours a week at like Starbucks. How are you going to charge $8,000 on a credit card to reap these benefits? You're not, right? So so just a friendly reminder. Know what you're getting yourself into, right? Do you need a platinum card? Do you need a gold card, a black card? No, you need a basic credit card with no annual fee just to start your credit. Yeah, in the future, once you have your career going, once you're established and you want all these rewards that you could take advantage of, no problem, feel free to take them, right? But right now, be careful, because I run into so many students that, look cool, right? They want to look cool because they have a platinum card, because they saw someone on Twitter or on Instagram like, "Oh, sign up for this, triple gold platinum rewards card that's going to give you 5% cash back and all this." Oh, but they don't tell you the fine print that you have to spend $10,000 a year on the credit card. If not, there's a $500 annual payment. So just keep that in mind. One of my pet peeves, just because I like to share, because it does happen. People do get them. So the cost of buying a car. So what is the importance, right? We talked about the importance of having good credit, all that good stuff. What does it mean? But let me give you an example of cost of buying a car when someone has a credit score of 750 and 620. So let's just suppose here I have the 620 credit score. Alana has the 750 credit score. I have the 620 maybe because I forgot to pay a bill, right? Maybe because I'm over the 30% usage. Maybe because I co-signed for someone and they messed up my credit card. So now I'm stuck with a 620 credit score. So let's suppose Alana and I are in the credit union today. We both looking at same car, same everything, right? $20,000, 66 month. Her interest rate is going to be 6.29. My interest rate is going to be 13.19 because I have a lower credit score. Her payment is going to be 359. Mine is going to be 428. Now, for someone who doesn't know how credit works, you might be happy with like, well, okay, 428. There's only a $69 difference there. Who cares? We both walk out happy, right? We both have our cars. We're both excited, right? I don't really know what a 6 credit score is. I don't really know what a 13.19 interest rate is. Believe it or not, when I used to do car loans inside the branch, people I would say about 60% of the people would ask me what the interest rate was. The other 40% wouldn't even care what the interest rate is. All they care about is the monthly payment. You should actually care more what the interest rate is than the monthly payment. For those of you that have purchased a car recently or gone to the dealership and try to purchase a car, next time you're in the dealership, notice how they always want to mention the monthly payment and they don't mention the interest rate, guys. It should be more important to you the interest rate than the monthly payment, guys. Very important. The interest rate is actually more important than your monthly payment because that's going to show you the amount of money extra you're paying, right? How much is the loan costing you? Because when you get a car loan for $20,000, do you pay only the $20,000? No, you're going to pay the 13.19 interest, right? That's how financial institutions make money. So just keep that in mind. Of course, going back to this, why is it important? Right? What's the difference between having a 750 and a 620? Well, in a case of getting a $20,000 car loan, I am going to be paying over $4,500 more extra, however you want to call it, more, right? I'm throwing away $4,500 because I have a bad credit score, guys. So imagine if you were in getting a home loan and that home loan is for $1,000,000 and you have a 750 credit score and I have a 620. I'm going to probably be paying hundreds of thousands of dollars more for the car loan over the life, right? For 30 years because I have a bad credit score, guys. That's why it's important to have good credit, guys. That's why it's important because it's going to save you money. I guarantee you, if you get $1,000,000 home loan and one of you have bad credit, the other one has good credit, that's the difference between potentially someone retiring or not. Why is that the difference between somebody retiring or not? Because you're throwing away so much extra money that you could potentially be putting into a retirement account, that you could potentially be putting into a savings account. I get this question quite a bit. So if I am husband and wife, boyfriend, girlfriend, partner, whatever that is, and my significant other has a, let's say, an 800 credit score and I have a 600 credit score. When we go out to get a car loan, whose credit score do they use? Do they use both? Do they use one of ours? Does anyone know what they use to figure out credit when there's two people signing on a loan? Is it both of us? Is it one of us? How do they do it? Does anyone does anyone know what credit to use? Highest credit score? That's a good guess. But unfortunately, that's not right. The lower one? No, not right either. They're going to take an average, guys. So, for instance, if my wife has a 800, I have a 600. for the loan purpose, we're going to have a 700 credit score. So in my case, my wife will probably be upset at me for having a low credit score because instead of getting the best rate, now we're getting a higher rate and we're paying more. So just keep that in mind. I always encourage one, and this a lot of people laugh, but I always ask the question during credit seminars. A lot of people do a lot of stalking when it comes to their significant other, right? You stalk them on Instagram, Snapchat, in the bushes. Maybe you ask around, right? How you should really stalk someone, right? Run their credit score, right? And then that'll tell you some very important information, right? If they miss payments, what their credit score is, because guess what? You're gonna find out. And people don't believe me when I say this, but when you marry someone or when you get serious with someone, their credit becomes your credit and their debt becomes your debt. So just keep that in mind. I know some people might be laughing. That's not going to happen to me. It happens all the time, guys. I've seen it happen where, the guy has a 500 credit score and, her girlfriend comes in like, oh, yeah, I have good credit. Just use mine. Well, we can use yours, but you know what? For a home loan, we're going to need two incomes. Or for a car loan, we're going to need two incomes because you're not making enough. And we need to add that. And they start arguing, right? Because now their interest rate went from 6.29 to maybe 10%, right? Because the average of the credit scores. So just keep that in mind. One last thing I did want to mention, and I always like to mention this during my presentation, doesn't have to do anything with credit, but this very important, I believe. This same slide was shared to me when I was 19 years old. So a long time ago. 401k guy, I like to share this because you always have time to prepare and you should prepare right for retirement. Don't care how young you are. I was 19 years old, working. Just started working at Bank of America. My financial advisor showed me this and said, hey, Oscar, sign up for your 401k. It's not going to hurt you, right? In a few years, right, when you retire, you're going to thank me. And I will. Because 401k retirement, you put away $100 per month. You work 50 years, 8% rate. That's what we think the S&P 500's done the last 30 years. So we think we're going to do that again, going forward. Starting amount. So you start off with $100. Your total contribution is $60,000. That's how much money you put in. Look at this, guys. Your total interest you earned is over $662,000. That's what we call compound interest. Your ending balance is over $700,000. That's what you have to retire with. I mentioned this a couple reasons. Why? Because I didn't know. I was first generation college student when, many years ago. I didn't know what retirement come. Again, my parents were immigrants. They never taught me about 401k because they didn't have one, right? They didn't know how that worked. Secondly, because 40% of Americans by the age of 40 don't have $5,000 in a 401k, guys. $5,000 is not enough money right now, right? It's not even a good weekend in Vegas. So just keep that in mind. You want to start saving for retirement as soon as possible. This is a great resource for you. Again, thank you for your time today. If there's any questions, feel free to ask them in the chat. If you want to reach out to me, best way to do it is through email, just because I'm in and out of the office. Or if you see me on campus tabling, feel free to stop on by and say hi. Again, thank you for your time. And I'll turn it back to Ilana. Thank you.
Wow, thank you so much, Oscar. I think we all learned a bit of something today. So really appreciate you taking the time to come on out. Before I wrap all this up, does anyone have any questions that they wanted to ask Oscar? Feel free to put anything in the chat also or in the Q&A box. And if you have more kind of one-on-one questions you'd like to ask, you're definitely welcome to reach out to him via the contact info in this slide as well. So I just want to thank you all for being here today. We do have one more in this Money Move series. It's going to be next week on April 29 at 5 p.m. This is about saving for the big stuff. So if you're looking at purchasing cars, doing some travel, homes, and other life goals, please feel free to join us for that. I'm going to drop the info in the chat as well as the registration right now. So it's going to be a Zoom webinar as well. So please feel free to sign up and we will send the recording of this also. And then other than that, please stay in touch. You're welcome to check out our alumni website for other upcoming events and programs that we're offering. And I will send a recording of this too to all of you who were here today. So just thank you again so much for joining us and have a great rest of your day. And thank you so much, Oscar. Appreciate you.
All right. Okay. We'll talk next week.
Sounds good.